All right, let's get right into it. We're not here to learn how to predict the market or chase after the next hot stock. Nope. Instead, we're going to dive into Benjamin Graham's masterpiece, The Intelligent Investor, and pull out a timeless framework for making smart decisions. When we're disciplined, not some crystal ball, is the real key to success. So why should we listen to this guy Graham? Well, when maybe the most successful investor of all time, Warren Buffett, calls it by far the best book on investing ever written, you gotta pay attention. Buffett's whole thing is that you don't need to be a genius, you just need a solid intellectual framework that keeps your emotions from wrecking everything. And guess what? This book is that framework. And that brings us to the fundamental question Graham asks every single one of us. Are you prepared to profit from the market's foolishness, or are you going to get swept up and participate in it? That choice right there between rational action and emotional reaction is pretty much what this entire strategy is about. So first things first, we have to choose a path. Graham is crystal clear on this. There's a huge difference between being an investor and being a speculator. They are not the same thing, and confusing the two, well, that's a recipe for disaster. Graham's definition of what an investment actually is couldn't be simpler. It's got three key parts. First, you have to do thorough analysis, no shortcuts. Second, it has to promise safety of your principal. And third, it offers an adequate return. Notice he says adequate, not get rich quick overnight. Analysis, safety, and an adequate return. That's the whole formula. So let's look at these two mindsets in action. The investor, they're analyzing the actual business, asking, how much is this company really worth? They're essentially buying a piece of a business. The speculator, on the other hand, is just betting on which way the price will move, asking, how soon is it gonna pop? They're just watching a ticker symbol go up and down. Okay, so if investing is all about analysis and not just gambling, how in the world do you deal with the market's wild emotional mood swings? Graham gave us this absolutely brilliant metaphor for it, an erratic business partner he calls Mr. Market. So imagine you own a piece of a business, and every single day, this partner, Mr. Market, shows up at your door. He offers you a price either to buy your share from you or sell you his. Now, some days, he is totally euphoric. He thinks the future is amazing and offers to buy your shares at ridiculously high prices. But then, other days, oh man, he's a complete mess, absolutely terrified. He's convinced the world is ending and desperately tries to sell you his shares at rock-bottom prices just so he can get out. And here's the most important part of the whole story. You don't have to do a thing. Mr. Market is there to serve you, not to guide you. You are completely free to just ignore him. Or you can take advantage of him. You buy when he's panicking, and maybe you sell when he's feeling a little too giddy. His mood is your opportunity, not your master. Now, being able to take advantage of Mr. Market's moods is only possible if you have what Graham calls the central concept of investing. This is the absolute key to protecting your money, your margin of safety. Look, if you remember nothing else from this, please remember this. The three most important words in all of investing are margin of safety. It's this simple but incredibly powerful idea that lets you sleep at night because you don't have to predict the future perfectly. So here's how it works. Every stock has a market price, right? It's driven by emotion, by the news, by mood swings, and it bounces around every single day. But that same stock also has an underlying business value based on real things like assets and earnings, which is much, much more stable. The gap between that stable value and the crazy fluctuating price, that is your margin of safety. Your job is to buy when that gap is nice and wide. Buffett, Graham's star student, explained it perfectly. He said, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. That extra room, that buffer for error, that's your margin of safety. It protects you when you're wrong or when just plain bad luck hits. All right, so how do we take all this great philosophy and actually put it into practice? Well, Graham provides a really simple, disciplined framework for what he calls the defensive investor. He suggests a super simple starting point, a 50-50 split between stocks and high-quality bonds. Now, this isn't about trying to guess which one is going to do better. It's about creating a disciplined, all-weather foundation that stops you from getting too greedy in a boom or too scared in a bust. And the essential companion to your margin of safety is diversification. Why? It's pretty simple. Because even if you buy with a huge margin of safety, any single company can run into problems you just can't predict. By owning a whole bunch of different investments, you make sure that the few that lose are more than covered by the profits from all the others. Now, for the stock part of your portfolio, Graham believed you should buy stocks like you buy groceries, not like you buy perfume. What does that mean? It means careful, unemotional evaluation, not just getting swept up by fancy packaging or a good story. So here's a simple little checklist inspired by his criteria. You're looking for big, well-known companies. They need to be in strong financial shape, more assets than debt. You want to see a long history of stable earnings, and this is a big one, a long record of actually paying dividends. And finally, you want to buy it at a reasonable price, a sensible price to earnings ratio. See, it's not rocket science, it's just good old-fashioned business sense. All of these principles, every single one, they all lead to the final and frankly the most important part of this whole puzzle. Your success isn't about being smarter than the next person. It's about mastering yourself. After decades of watching the markets go crazy, Graham's ultimate lesson was this. In the end, how your investments behave is much less important than how you behave. It's your character, your discipline, and your patience that are your greatest assets. And so we end right where we began. Mr. Market is always going to have a mood. He'll be euphoric one day, terrified the next. The only real question for you, the intelligent investor, is this. Are you going to let his mood dictate yours?